All right, welcome back to the program. Joining me right now is Johnson Chukwu, who is the Group Managing Director at Cowry Asset Management. Mr. Chukwu, I can see you, crystal clear there. Welcome to the program. Good morning to you from Abuja. How is Lagos? Okay, so the thing just vanished. Let's try as much as possible to reconnect with him. Earlier on, I did say that I'll be speaking about the MPC outcome today, but let me quickly give you a summary of what happened in January. For those of you that monitor the MPC or you're wondering what the MPC is all about, the MPC is called the Monetary Policy Committee. These meetings happen 6 times a year. At the last MPC meeting in January, the MPC kept MPR, which is monetary policy rate, unchanged at 11.5%. In fact, for that January MPC meeting, the communique was heavier than all other communiques that I've seen, at least for 2020 and for 2019. I think there were about 15 pages for January communique. And I did ask why, because there were a lot of things. Then we were still in a recession, and the Nigerian economy just recovered slightly, GDP growth of 0.11%. So many things the MPC for March will be looking at. Johnson Chukwu is joining me again. I hope the network doesn't misbehave. Welcome, Mr. Chukwu.
Thank you, Nancy. Good morning, and thank you for having me.
Thank you very much for joining us. Let me start. I was just analyzing the MPC earlier on, especially for our viewers that perhaps are just watching for the first time and they don't know what the MPC means, Monetary Policy Committee. Okay, just do a 30 seconds explanation. Continue from where I stopped. Then we'll take it from there. Okay. What is the MPC and why are these meetings 6 times in a year very necessary? So we'll take off our discussion from there.
Nancy, I hope you've not lost the connection.
Go ahead, I can hear you.
Okay. The Monetary Policy Committee is a committee of the central bank and some established or knowledgeable economists that meets every 2 months to determine what you call benchmark rates. The benchmark rates are those rates that define interest rates within the environment, such as the liquidity ratio of the bank, that is the amount of money the bank must give with the central bank out of their total deposits. They also define the monetary policy rate, which is what we call the MPR. The MPR is the rate that determines the rate at which banks borrow from the central bank, at which banks also lend or keep money with the central bank. There's always a corridor between the rate they lend to the central bank and the rate they borrow from the central bank. And that monetary policy rate also defines the rate which they lend to the public, because the rate which they will borrow money from the central bank will also influence the rate they lend to the public, as well as. So that drives interest rate environment, interest rate within the environment. The liquidity ratio is a contributory factor to the volume of liquidity they have that will determine how much of their deposit they can lend out. And then you have the cash reserve ratio. The cash reserve ratio is the quantity of their total deposit they must keep with the central bank to meet exigencies of their customer or demands of their.
This network doesn't want me to talk to you. This network wants me to be the anchor as well as the guest this morning. All right, let's continue from where we stopped. I like that you explained what the MPC means. So for those of our viewers that don't know what it is about, you've explained that. What kind has the MPC now, this March MPC, has it faced this kind of trilemma, I call it, rising unemployment, rising inflation, depreciation of the naira? Perhaps it's even more than a trilemma. If there's anything more than a trilemma, this MPC is facing it. So has the MPC faced this kind of challenge before?
Yes, I think in 2017, early 2017, the same environment we are today. But we also had rising unemployment, low economic activities at the point we were coming out of. We're still in recession the early part of 2017. I mean, at that point, the inflation rate got to, in January 2017, it got to 18.72%, which was the highest we've seen in the past six years. So we've seen similar instances, but of course there are also peculiarities associated with each time period. I think clearly you have talked of dilemma.
Okay. All right, Mr. Chukwu, let's try to reconnect back. Perhaps, okay, Mr. Chukwu, are you there now?
Yes, I am.
Okay, please continue.
Okay, so what I was saying, clearly the Monetary Policy Committee has a very difficult task at hand, because to balance the demands of an economy that is witnessing an inflation rate of 17.3%, and at the same time, the economy is just coming out of recession. You are having high level of employment to the level of 3.3% of the economic.
So I think what they may be left with is the option of keeping rates at current levels.
Okay, is that your expectation? Do you expect them to keep rates at current levels? That's to hold?
Yes, given the contradictory pressure they are currently facing. Anything otherwise would worsen some of those parameters that I'm sure they wouldn't want to see worsen. I did mention the issue of inflation rates. Nobody wants to adopt an expansionary policy at this point to further stimulate the economy at the expense of an inflation rate that has gotten as high as 17.33%. At the same time, you can't apply the brakes. You can't say let's adopt contractionary policies, because in as much as that will moderate inflation, it has the tendency to reverse the economic recovery witnessed in the last quarter of last year.
Now, let's talk about this inflation and how much of an economic threat is inflation. We're seeing inflation rising to the levels that we had, I think, perhaps in 2016, if I'm not mistaken, 17.33%. Food prices at its highest. So for how much of an economic threat is inflation for a country that is the poverty capital of the world, for a country that unemployment has risen to 33%?
Well, the key thing is that inflation erodes the standard of living of citizens, particularly on those on fixed income, those who are retirees, those who are employees who are earning specified of the income on a monthly basis. When you see inflation rate at the level that it has today, you are dealing with today, then this incentive to work harder is eroded. But most importantly, the standard of living of those average citizens is eroded, because they can no longer afford afford the same quantity of goods and services they used to afford with their income. So what happens is that the quantity of goods and services they can buy with the income they have been earning keep decreasing as the inflation is rising. It's also a disincentive to save, because when you have high rate of inflation, it becomes not wise to save your money and consume later. So what they call deferred gratification, which is what drives economic growth, because deferred gratification leads people to save and invest, hoping that they will consume in future. But if the inflation rate is high, so that if you save your money today, you are not able to spend that, you are not able to afford the goods you would have bought today. Take for instance, if there is a commodity that is selling today at 100 naira, and you don't buy it today at 100 naira, you plan to buy it in 1 year time, you need to buy it at 117 naira 33 kobo. But if you save your money today, even if you buy a federal government 364-day treasury bills, which is the highest yielding short-term instrument at 7%, it simply means by this time next year, assuming inflation rate remains at the level it is today, you would have only gotten 107 naira, whereas you need 117 naira 33 kobo to buy that good. So it discourages you from saving to buy in future, to consume in future. And any economy that does not have savings will not have investment, because it's the accumulation of savings that leads to investment. So high inflation rate slows the economic growth. And particularly for emerging economies, it's a more difficult thing, because you need a lot of savings to encourage investment.
Now, the question arising from what you've just said, if there is no incentive to save because inflation is eroding the naira, so where should we put our money? You know, where should we put our money? The treasury bill space is also quite stifled. Now, where do we put our money?
Okay, let me start by speaking of what I think the central bank is currently doing. If you observe the short-term money market segment, you will observe that the central bank has, in the past 8 weeks, been upping the yield on treasury bills. If you look at the 364-day bills today, which is trading at about 7%, it started about 10 weeks ago at just barely 1%. Then it moves to 2%, and then moves to 4%, and then moves to 5.5%, and then moves to 6.5%, and now 7%. So we've seen steady jump in yield on short-term debt instruments, which means central bank is trying to move interest rate to, at the minimum, reduce the gap between inflation rate and interest rate, so as to incentivize people to resume their savings and reduce consumption.
So in essence, what you're saying is that to put money in treasury bills, since it's rising,
as events are unfolding, the treasury bill space may be an area to put money. But you can also put money in Eurobond instruments. For instance, corporate Eurobonds, sovereign Eurobonds. If you have the wherewithal to buy instruments, Eurobond instruments, the simple reason that part of the factor driving inflation is exchange rate devaluation. So if you buy an instrument that is dollar denominated within the local environment, you insulate yourself from naira devaluation, which moderates the impact of inflation on you. Because eventually, if naira devalues further and you convert back your dollar into naira assets, you realize that you have made up for the depreciation of the local currency, because the conversion rate will be higher in terms of naira value you will get. That's the second option you have. The third option was the equity space. But interestingly, because interest has begun to recover, investors are staying back on equity instruments. But there are still some equity instruments that give you a dividend yield of 12, 13 to 14% at the current market prices. So those instruments also present, if you are a discerning investor, or if you come to an institution like Cowry to guide you, the equity instruments that have yield that are
Mr. Chukwu, you will pay me for these adverts now, seriously speaking.
Okay.
Go ahead.
There are instruments that are currently, that will give you dividend yield currently close to the inflation rate. But the fact is that the inflation rate today is quite high, and every effort should be done to bring it down. If by the time, which is why stable economies have inflation rate of 1-2%, and that it makes for ease of investment decisions.
Okay, let's still stick with this inflation a bit, and let me ask you this question. From the COVID-19 interventions that we saw in 2020, do you think that the COVID-19 interventions from the Central Bank of Nigeria also added to the inflationary pressure that we've seen so far, at least towards the end of 2020 till now? Because the bank, I guess, is still, or NISAL is still disbursing. As of January, the Central Bank of Nigeria did say that it has disbursed about 192 billion naira to over 426,000 beneficiaries. I hope we'll be getting more updates on that. But do you think that it also added to inflationary pressure?
I don't think so. You know why I don't think so is that the liquidity injection from the central bank interventions is not overwhelming. Okay. And we don't have a liquidity surface. The driver of inflation today in Nigeria is not excess money pursuing few goods. The major fact that driving inflation are structural bottlenecks created by insecurity in the country. If you look at the inflation figure for February, food inflation of when you disaggregate the 17.33% all item inflation in February, food inflation was 21.79%, whereas non-food items was only 12.38%. The preceding month, food inflation was 20.57%, and non-food item, all items excluding volatile food items, was 11.85%. So if you look at the gap between food inflation and non-food inflation, other items, you will realize that the pressure we are getting is coming from food inflation. Like I said, a food inflation of 1.79% that drove all item inflation to 17.33%. So the problem is food inflation, and the food inflation can actually be attributed to the displacement of farmers in many of the farming belts of the country, the northwest, the northeast, and the north central. Okay. And therefore, we are no longer producing enough food to service our 206 million population.
Now, with all this myriad of challenges facing the monetary authority, what immediate policy responses that would be effective do you think that they would exercise? Or have they run out of tools?
I wouldn't say they are run out of tools, but some of the tools they use are getting very blunt because they are not, the pressures we're getting today in inflation is not driven by monetary, by liquidity, from liquidity suffix or excess liquidity in the economy. To address the challenges we have today, it has to come from the fiscal authorities. I mentioned the core of the problem, which is insecurity. If you address the issue of insecurity, you are going to bring down food inflation. When you bring down food inflation, all item inflation will come down. Assuming food inflation was just at the same level with all item inflation of 13.85%, 83%, 12.83%, we will be talking about inflation of about 12.83%, not 17.33%. And that's the core of the problem. Then the other things are medium to long-term issues, improving infrastructure supply to ease the cost of doing business in the country, because ultimately you have to lower the cost of your doing business in arriving at your price.
Okay.
So, but the first thing, hanging fruit that we must address the issue of insecurity to bring down food inflation.
So in essence, this March MPC meeting, the solutions is not going to be coming from there. It's going to be coming from fiscal policy or perhaps the executive in terms of addressing the fundamental problems that Nigeria is currently facing.
Absolutely.
Okay, let's move over to Global Money Week now. The theme is take care of yourself, take care of your money, especially now that we're still in a COVID world. Mr. Chukwu, speak to my viewers how they can take care of themselves and take care of their money. Is it possible? How do you do that?
Yes, the reality is that if you do not take care of yourself, which is take care of your health, you won't be in a position to take care of another thing because health is core to being economically independent. And so the starting point is that you must be healthy. When you are healthy, you are in a better position to engage in economic activity and generate revenue or income. So you must ensure that you don't expose yourself to COVID. You don't get to the point where you get infected. If you happen to get infected, you make sure you go for treatment quickly.
Okay, Mr. Chukwu, in just 10 seconds, because we should go now. How do you take care of your money?
Yeah, the next thing is that you need to understand personal financial management. You need to understand the principle of savings. You must understand the principle of investment. You must understand the principle of risk. And you must be able to measure your own risk appetite. And you must know which station you are in life and know the kind of risk you can take. So if you do not have any of this, look for somebody who is a professional industrial to guide you. Make sure you do not invest in any instrument that gives you excessively good return, because if it is too good to believe, then it is really not real. It is really not real.
Okay.
So you must avoid Ponzi schemes that suck in people and make them throw away their resources.
Thank you very much, Mr. Chukwu. And I think the icing on the cake, taking care of your money, should be watch Moneyline with Nancy. I thought you were going to say that.
Okay, thank you for reminding me of that. But that's very key, and I'm sure that's why all your guests are tuned in.
Okay. Thank you very much, Mr. Chukwu, for joining us.
Thank you.
All right, I've been speaking with Johnson Chukwu, who is the Group Managing Director at Cowry Asset Management. That's the much we can take for today, but don't touch that dial. The news is up next, and I think about 2:30 p.m. later today, the MPC meeting decisions will be broadcast on the station. Be the best you can be and be the change you want to see. I am Nancy Naji. Bye now. Thank you for watching our video. Please hit the subscribe button below, turn on post notification to follow all our updates.